Right now, with major stock indexes sitting near record highs and full-year profit growth expected to come in near 23%, some of the same analysts who spent the last 2 years telling investors to stay aggressively invested are quietly starting to say something different. Maybe it's time to take some money off the table. This sounds backward. Why would anyone suggest selling into strength, trimming positions that are working, stepping back from a rally that is still climbing? Every instinct built into the human brain says the opposite, that a stock going up is a stock you should be buying more of, not less. And yet some of the most disciplined voices in the investing world consistently arrive at this same uncomfortable conclusion during periods that look exactly like this one. Understanding why requires letting go of the idea that selling a winning position is a betrayal of that position, and replacing it with a much older, much less emotionally satisfying idea, that the price paid for an asset relative to what it can realistically deliver matters more than how exciting its recent performance has been. There is a specific term traders use for the kind of price action markets have shown in certain corners recently: a parabolic move, a rise that doesn't just go up, but accelerates upward, each stretch of gains arriving faster than the one before it. A steady, healthy climb looks like a gently rising line. A parabolic move looks like a line bending sharply toward vertical, the kind of shape that, in almost every area of the natural and financial world, cannot sustain itself indefinitely. This matters because the human mind is genuinely bad at intuitively grasping what acceleration actually implies. A trend that has been accelerating for months feels, psychologically, like it will simply continue accelerating, because recent experience is the most vivid data available to any observer. But acceleration, by definition, consumes its own fuel faster over time. And the sharper the upward bend, the less room remains before either the pace slows on its own or the market forces a much rougher correction to bring price back in line with what the underlying business can actually support. The math behind current valuations helps explain why caution has started creeping into otherwise bullish forecasts. Heading into this earnings season, the broad market was trading at roughly 21 times forward expected earnings, a premium of about 7.5% above its own 10-year historical average. In plain terms, investors are currently paying more for each dollar of expected future profit than they have on average over the past decade. This is not automatically a warning sign. Markets can and do trade above historical averages for extended stretches, particularly when growth genuinely accelerates to match the optimism. But it does mean the margin for error has narrowed. When a market is priced cheaply, disappointing news tends to get absorbed without much damage because expectations were modest to begin with. When a market is priced at a premium, even a minor shortfall relative to already high expectations can trigger an outsized reaction because there was very little cushion built into the price to begin with. Selling a position that keeps rising runs directly against one of the most stubborn instincts in investor psychology, the fear of missing out on further gains. Loss aversion, the well-documented tendency to feel the pain of a loss more intensely than the pleasure of an equivalent gain, usually gets discussed in the context of holding on to losing positions too long. But it has an equally powerful mirror image that shows up during rallies. Investors who sell a winning position and then watch it continue climbing without them experience a very specific, very sharp form of regret, one that feels almost identical to an actual financial loss, even though no money was actually lost. This asymmetry, fearing the regret of selling too early even more than the risk of holding too long, quietly nudges people toward staying fully invested in an overextended position well past the point where a calm, unemotional analysis would have suggested trimming it. The fear of missing tomorrow's gain, in other words, often overpowers respect for today's stretched valuation.
There is a second, subtler trap layered on top of this one, something financial behavioral researchers sometimes call the house money effect. Once an investment has produced substantial paper gains, many people begin treating those gains differently than they treat their original capital, mentally categorizing them as the market's money rather than their own, as if the risk of losing profit somehow matters less than the risk of losing what was originally invested. This mental accounting is completely irrational from a financial standpoint. $1 of unrealized gain sitting in a portfolio is exactly as real and exactly as capable of disappearing as $1 that was deposited directly from a paycheck. But the psychological distance from that dollar's origin makes people willing to tolerate far more risk with it than they ever would with fresh capital, which is precisely how investors end up holding far larger, far riskier positions than they originally intended, simply because the position grew large through gains rather than through deliberate additional investment. There is a far less emotionally charged approach that professional portfolio managers rely on, precisely because it removes psychology from the equation almost entirely: periodic rebalancing. Instead of trying to guess when a rally will end, an investor using this approach simply decides in advance what proportion of a portfolio each asset class should represent, and then periodically trims whatever has grown beyond its target share, redirecting those proceeds toward positions that have fallen below theirs. This is not a prediction about the future. It requires no opinion at all about whether a particular stock or sector will keep climbing or is about to fall. It is simply a mechanical discipline that, by its very structure, forces an investor to sell portions of whatever has recently performed best and buy portions of whatever has recently lagged, a pattern that, over long stretches of market history, has tended to improve returns precisely because it removes the emotional impulse to chase whatever is currently exciting and abandon whatever currently looks unglamorous. It is worth being precise about what taking profits during a stretched market actually means, because it is easily confused with something far riskier: trying to call the exact top. Nobody, no matter how experienced, can reliably identify the single best day to sell an asset before it declines. Attempting to do so is less an investment strategy than a guess dressed up as analysis. Disciplined profit-taking is a fundamentally different exercise. It does not require knowing when a peak will arrive. It only requires recognizing that risk has grown large enough relative to a household's goals and tolerance for volatility that trimming exposure makes sense regardless of what happens the following week. This distinction, probability management instead of precise prediction, is what separates thoughtful risk reduction from speculative market timing. And confusing the two is one of the most common reasons people either freeze during overextended markets, afraid of selling too early, or panic sell during downturns, afraid of holding too long. History offers a vivid, sobering illustration of what can happen when a market's confidence in its own upward momentum becomes fully detached from a sober assessment of risk. In the years leading into 1929, American stocks climbed for so long and so consistently that widespread public enthusiasm became one of the defining features of the era, with everyday investors increasingly borrowing money specifically to buy more shares, betting that the rally itself had become close to a permanent feature of the economy. When that confidence eventually broke, the resulting crash and the deep economic depression that followed reshaped financial regulation and investor psychology for generations afterward. The specific causes were complex, involving leverage, weak banking oversight, and broader economic imbalances well beyond stock prices alone. But the underlying psychological pattern, a long climb gradually convincing more and more people that the climb itself had become the safe, obvious bet, is a pattern that has echoed through nearly every major market euphoria since, not because history repeats exactly, but because the emotional mechanics driving investor behavior change far less than the specific assets or technologies involved.
A more recent, equally instructive example comes from Japan in the final years of the 1980s, when a combination of real estate and stock market enthusiasm pushed asset prices to levels that, in hindsight, had become disconnected from what the underlying economy could realistically support. At the time, confidence in continued growth felt entirely justified to most participants, backed by genuine decades of remarkable economic development. When the bubble eventually deflated, Japan's major stock index entered a decline that, remarkably, still had not fully recovered to its previous peak even decades later. This example matters because it challenges a comfortable assumption many investors quietly hold, that markets always eventually recover fully within a reasonable time frame. Sometimes they do, often within a few years. Sometimes the recovery takes far longer than an entire working career allows for, which is precisely why respecting valuation and managing risk during euphoric periods matters even for investors who consider themselves patient, long-term participants rather than short-term traders. There is a specific mechanical reason why elevated earnings growth expectations, exactly the kind currently baked into forecasts calling for profit growth near 23% this year, create their own particular form of fragility. When expectations are already this high, companies do not simply need to grow, they need to grow at a pace that continues meeting or exceeding an already demanding bar, quarter after quarter, with very little room for the ordinary hiccups that occur in any real business: a supply chain delay, a softer month of consumer spending, a slightly higher cost of materials. This is the same dynamic that played out with individual companies elsewhere this earnings season, where genuinely strong results still triggered sharp sell-offs simply because they failed to clear an unusually high bar. When that dynamic applies not just to a single company, but to an entire market pricing in unusually strong aggregate earnings growth, the risk becomes systemic rather than isolated, meaning a broader disappointment has the potential to ripple across far more of a portfolio than a single stock-specific stumble ever could.
None of this argues for abandoning the market entirely or attempting to sit in cash, waiting for some clearly signaled all-clear moment that, in practice, rarely announces itself with any clarity at all. The more practical response involves a handful of concrete, unglamorous adjustments. Reviewing position sizes to ensure no single stock or sector has grown, through gains alone, into a dramatically larger share of a portfolio than originally intended. Maintaining genuine diversification across asset types that do not all respond identically to the same news. Keeping a modest reserve of available cash, not as a bet on a coming decline, but as flexible capital ready to take advantage of better prices if a correction does eventually arrive. None of these steps require correctly forecasting the market's next move. They simply ensure that whatever happens next, whether the rally continues for another year or the market finally takes the breather that stretched valuations have been quietly warning about, the portfolio remains structurally prepared for either outcome, rather than optimized for only one of them. The hardest trade in investing has never really been buying at the bottom, despite how much attention that moment receives. It is trimming a winner while it is still winning, resisting the very real, very human urge to let a good story keep writing itself indefinitely, simply because it has felt so good so far. Markets have never rewarded certainty about the future, because that certainty is, and has always been, unavailable to anyone. What they have consistently rewarded, across decades and across very different economic eras, is a quiet respect for the relationship between price and value, and the discipline to act on that respect, even when the loudest, most exciting story in the room says the party has no reason to end. That discipline rarely feels satisfying in the moment it is exercised. It only reveals its full value later, in hindsight,
to whoever was patient enough to practice it before the reason for it ever became obvious to everyone else.